Is investing in Canadian real estate market still a good idea? That is what we are going to discuss in this video, so stay tuned. Hello, this is Sonia, your local realtor with Remax Realty Specialist. Welcome to my channel where we love talking about real estate and all things in and about Greater Toronto area, and we would love to take you along the ride. So hit that subscribe button and the little bell icon so you get notified every time there is a new video uploaded. Over the last few years, investors have played a significant role in the housing boom that has taken place in the Canadian real estate market, especially in the major markets such as Toronto and Vancouver. Late last year, there was a lot of buzz when it was reported that more than one quarter of the Ontario real estate market was controlled by investors. In Toronto, investors have acquired more than one-third of recently completed homes. Overall, one-fifth of homes in the average Canadian city are owned by investors, according to Bank of Canada. Now that the market conditions are starting to shift this year, be it higher interest rates or buyer exhaustion, are investment properties still a good strategy? Canada's annual inflation rate surged to 5.7%, the highest level since September 1991. Some economists contend that it would be higher if real estate prices counted. Nevertheless, the inflation rate is well beyond the central bank's 2% target. As a result, Bank of Canada is widely anticipated to hike interest rate a few more times throughout 2022 to help combat inflation. Will rising interest rates crash the housing market, or might they have little to no impact on the sizzling red-hot real estate market? Today, interest rates remain near record lows, which has immensely lowered borrowing costs. Unless the central bank pulls the trigger on a 100 basis point hike, a quarter point move is unlikely to make a substantial dent in borrowing endeavors. And this could be good news for real estate investors because now they have a little more time to lock in lower rate mortgages and take advantage of cheap debt. Although investment properties deter investors in a rising rate environment since they will seek out yield in more conventional assets, this is not a standard market right now. Canadian real estate prices have skyrocketed to an all-time high. In the sizzling markets such as Toronto and Vancouver, the average sales price is way above $1 million mark. Supply is low, demand is high, and new housing construction is tepid. The Bank of Canada ending its quantitative easing program, which has become the norm, impacts the broader financial market. At the same time, some financial experts think it would cool down the meteoric growth, potentially preventing investors from trying to cash in on massive gains, especially if they buy near the top. Rob Carrick from the Globe and Mail recently wrote, "Surging residential real estate prices illustrate how the housing market is virtually begging for higher interest rates. Without some sort of limiting force, rate hikes, taxation, tighter borrowing standards, house prices seem as if they will rise until either the last shreds of affordability disappear or we have a recession. Higher rates could slow the market down, thereby avoiding more extreme outcomes like a full-blown correction. Of course, if investors purchase these homes at the beginning of the pandemic, using them as the rental properties, then they are still in good shape since they maintain positive equity. Should you expect the worst in the housing market, and could the Canadian real estate market plunge in 2022? The financial markets are betting on several rate hikes over the next year, with investors doubling down on their bets since the Consumer Price Index climbed to a more than 30-year high. This has some market observers anticipating a crash. If the Bank of Canada goes at least as far as what the rates market has priced in, you are going to have arithmetically at least a 25% plunge in residential real estate values. As per David Rosenberg, an economist and founder of Rosenberg Research and Associates, there is a greater risk that they over-tighten, and they might over-tighten by even a couple of rate hikes. Mortgage debt has increased substantially, and with many investors taking on multiple mortgages, that's where the selling is going to initiate, but it will spread like dominoes. But other contend that the Canadian housing market will either stay the course of notable gains or cool down reasonably. Whatever the case may be, it should be an exciting time for investors in 2022. And if you're thinking of buying or selling real estate in Greater Toronto area, I'm just an email or a call away. Thanks for watching, and don't forget to join me next week. Until then, stay happy and stay safe.